Welcome everyone. This is our course on accounting made simple, and the topic we're going to cover today is going to be the basics of accounting. So what exactly is accounting? Accounting is the language of business. Business events are translated, recorded, and summarized in a uniform format to assist in decision making. Accounting rules and regulations allow accountants to communicate information that is understood by those fluent in the language. Now, the accounting process has four steps. The first step being a business activity occurs. Then the transactions are recorded, in which the accountant translates and records the activity. In the third step, financial statements are prepared, in which the accountant periodically prepares summary of all business activities in the form of financial statements. The fourth and the last step being decision making. Now, the users of this information review these financial statements to make decisions. Now, let us look at who are the customers of this financial information. There are two buckets in which we could put these customers: internal customers and external customers. External customers are comprised of management executives, the HR department, the FP&A department, the project management office, and the sales department. The management executives can use this information to determine in a company which product line is the most profitable. The HR department can use this information to determine whether the company can pay or can increase the salaries of their employees. The finance department can use this information to answer questions such as if they can pay dividends to their stockholders or not. The project management office can help determine the gaps in their business processes and further find solutions for those. The sales department can use these numbers to see how effective their sales methods are and further improve on those. Now, in terms of the external customers, we have regulators, investors, and creditors. The regulators are individuals such as auditors who help determine whether the finances of the business are not being misrepresented. The investors can use this information to determine if the business is a profitable one and if they would like to invest in a business or not. The creditors, such as banks, can use this information to determine how profitable the business is and then further give a credit line to the business or lend money to the business. Now let us look at the regulations and business structures. GAAP. A lot of you might have heard of this word. It stands for Generally Accepted Accounting Principles. Now these are a set of rules and practices having substantial authoritative support that the accounting profession recognizes as a general guide for financial reporting purposes. There are several standard setting bodies that help determine these guidelines: Securities and Exchange Commissions, SEC, Financial Accounting Standards Board, FASB, and International Accounting Standards Board, IASB. Now, further looking at the three types of businesses, we have sole proprietorship, partnership, and corporations. Sole proprietorship are businesses that are solely owned by individuals. These are simple to establish, owner controlled, and have a lot of tax advantage. Partnerships are those businesses that are owned by multiple individuals in partnership. They usually own a percentage share of the business. Like sole proprietorships, partnerships are also simple to establish. They have shared control. They have broader skills and resources given that they have multiple partners on board, and they're also tax advantageous. Now, lastly, corporations are owned by multiple investors. These are easier to transfer ownership, easier to raise funds, and have no personal liabilities. Now, getting into the technical concepts surrounding accounting, we're going to look at the balance equation, which is also the basic accounting equation. It is known as the ALOE equation. Assets is equal to liabilities plus owner's equity or stockholder's equity. So the three components of this equation are assets, liabilities, and stockholders' equities. Assets are resources owned by a business that can provide financial benefits in the future. A few examples of asset accounts are cash, which includes all currency, coin, and equivalents owned by a business. Investments, which can be tangible or intangible items obtained for producing additional income or held for speculation in anticipation of future increase in value. Examples of investment assets include mutual funds, real estate, investments, stocks, and bonds. Investments can also be termed as marketable securities. There can be short-term investments or long-term investments. AR, or accounts receivables, are cash owed to the company from customers in exchange for goods or services already provided to the customer but not yet paid for. Inventory are in-stock goods that are intended to be sold to customers to generate revenue for a company. Supplies, these are goods that are in stock to support operations and are expected to be used in the near future. These can be items like stationery, pens, papers, printer cartridges, etc. Further, prepaid expenses are services owed to the company that have already been paid for. Examples include prepaid insurance and prepaid rent. Property, plant, and equipment, PP&E, tangible, long-term assets owned by a company and used to support operations, fixed assets or plant assets. Intangible assets are assets that lack physical substance but provide value for a company in generating future revenue. Examples include copyrights, patents, and goodwill. An example of this can be the brand value associated with Apple. Now moving on to liabilities. Liabilities represent others' claims against a company's assets. A common trend that you'd notice in the liability accounts are that most of them end with the word payable, except for a few exceptions such as unearned revenue account. Salaries payable are the amounts owed to employees for work they have already performed for your business, also referred to as wages payable. Accounts payable are short-term debts owed to other companies with no formal debt instrument, typically for items already purchased by your company, such as inventory or supplies. Notes payable are amounts owed to creditors, such as banks, with a formal debt instrument referred to as a note, typically accrues interests. Bonds payable are principal balance owed to bondholders. Interest payable are amounts owed for interest payments on notes payable, bonds payable, or any other type of debt that incurs interest. Lastly, the non-payable account example that we have for liability accounts, unearned revenue, these are services or goods owed to customers that have already been paid for by the customer. Some examples include customer deposits, subscriptions, gift card, airline tickets, and annual subscriptions. Uh, it's kind of like if you buy an annual subscription for Spotify, so if you've already paid Spotify for the services you would receive in the near future. Now, last but not the least, stockholders' equity, which is often referred to as owner's equity, represents the owner's claims on total assets. Two examples of stockholder equity accounts are the common stock account and the retained earnings account. The common stock are stockholders' shares of ownership and claims to the company's assets. Now, retained earnings is the cumulative total of all net income and losses retained in the company. This represents the cumulative amount of a company's profits that have been reinvested in the company and not cashed out. The retained earnings account is increased when a company records revenues and decreased when a company records expenses and dividends. These revenues results from business activities entered into for the purpose of earning income. Common sources of revenue are sales, fees, services, commissions, interests, dividends, royalties, and rent. Expenses are the cost of assets consumed or services used in the process of earning revenue. Some common expenses are salaries expense, rent expense, utilities expense, tax expense, amongst many others. Dividends are the distribution of cash or other assets to stockholders. Instead of retaining and reinvesting them into the company, these can be given out to the stockholders. I hope this helped you understand the basics of accounting. I will see you in our next video, which will cover frauds and internal controls. Don't forget to like this video and subscribe to our channel for more such educational content. Thank you.